Why are some investors able to make bold, contrarian calls that seem to work against all odds? Today, I'm going to ask Jared Dillian why he's so bullish, why he thinks now might be the time to fight the Fed, and where investors should be looking today for opportunities. Jared Dillian is the former head of ETF trading at Lehman Brothers. He had a remarkably successful career on Wall Street before starting a research service. Today, he works with me at Malden Economics, where he writes 3 investment letters. He also continues to publish his own letter, The Daily Dirt Nap, which is read by thousands of market participants and high net worth investors. I hope you enjoyed this week's Global Macro Update discussion with my friend, Jared Dillian. Jared, it's good to see you. The Federal Reserve, of course, raised interest rates another 75 basis points this week, and they added something to their statement, which I found interesting. Let me just read this new addition to their policy statement. They said, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments, which I thought sounded pretty dovish, actually. But when Jay Powell started talking, the market went from green to red almost instantaneously, and it got worse the longer he kept talking. What was your take on the meeting? Is this a dovish meeting or a hawkish meeting?
It was a disaster of a meeting. in terms from like a communication standpoint, like you couldn't get more two conflicting messages. I mean, the problem I think is that Jay Powell is more hawkish than the rest of the FOMC. I mean, they spent 2 days in a conference room crafting this statement. That was the statement that they all agreed upon. And then Powell turned into a rogue hothead and gave a bunch of his personal opinions on rate hikes. I mean, the one that really sent the market down was he said that ultimate Fed funds, which is what he meant was terminal Fed funds, was probably higher than they initially thought. Right. So a lot of people were thinking terminal Fed funds would be 4.75, 5%. So now people are like, well, what does he mean? Does he mean 5.5? Does he mean 6%? And then he said, I think he said that you had to be very cautious about interpreting this as like a pause was a long way away or something like that. So it just went from bad to worse. So I don't think that was the message that the FOMC wanted to communicate. And the thing you have to keep in mind is the press conferences are pretty new. They started when Yellen was chair. They've only been doing them for 3 or 4 years. The Fed never used to do press conferences. And when you have Powell up there doing slam poetry, just ad-libbing, like it just creates like all kinds of opportunities and for uncertainty. I mean, if you look at a chart of the S&P 500 on an intraday, it's ripping all over the place as he's speaking. So it's just a mess. So your initial question was it a dovish meeting or a hawkish meeting? I still think it was a dovish meeting. And I think I haven't looked at the schedule of Fed speakers, but I think over the next couple of weeks, you're going to start to see people walk back some of the things that Powell said. That's my prediction.
So it sounds like they've changed a little bit what they're focusing on. They're acknowledging that their rate hikes are lagging in impact, and so maybe they need to reduce the size of their increases for a while, even if they are going to continue to hike. One of the things I found interesting was Powell said how high to raise rates and how long to keep monetary policy restrictive is now the big question. And that was also a little bit of a pivot on his part or on the Fed's part.
Yeah, I mean, I think they were not deaf to some of the criticism that they were getting. The criticism that they were getting was, look, I mean, we've hiked rates a bunch. We've had 4 75 basis point rate hikes in a row. It's one of the fastest rate hike cycles, I think the second fastest in history. You know, we should wait and see the effect of some of these rate hikes. So I think that they heard that criticism, and then then Powell just went off the reservation. So
Jared, you've been pretty bullish for at least a month now, and That's about as contrarian of a call as I can ever remember you or anyone else making. I think it was Marty Zweig who back in 1970 coined the phrase, "Don't fight the Fed." But it feels like you are fighting the Fed right now. You're fighting that simple adage, right? Like Druckenmiller reinforced it too. When the Fed was cutting rates, don't fight the Fed, just buy stocks. It's easy. Isn't it the reverse right now? Shouldn't you be getting out of the way? Why? What makes you so bullish?
Well, I mean, first of all, if you look in the Daily Dirt app in my newsletter, like my prediction for this particular Fed meeting was 100% correct. I said that they would hike 75 and that they would signal that they would be tapering rate hikes in the future. In essence, that's exactly what happened. So this is the pivot. Like, this is absolutely the pivot for the Fed. The next rate hike is not going to be 75 basis points. I think if you give the market some time to digest this, like you're going to see that this actually was the pivot. So I'm still bullish on stocks. I'm still absolutely bullish on stocks. And there's in that initial call was based on bearish sentiment that was absolutely out of control. People calling for a depression, people calling for a crash. Like it just got totally insane. And a lot of that bearish sentiment still exists. So the S&P closed somewhere around 3760. The low was 3500 on October 13th. So we're still up about 6 or 7% from the low. As of a couple of days ago, we were up about 10 or 11% from the low, and it ended up being the best month for the Dow in a really long time. So I'm sticking with this call.
And is this a trade, Jared, or are you think we're in a new bull market?
Well, I don't know. I mean, it is a trade. Okay. So, I got long a while ago and I'm still long. I think the S&P 500 could go to about 4,100, 4,150. And at that point, you kind of have to reevaluate whether this was just a correction in the context of a bear market or whether you think it's a new bull market. I'm a trader. So at that point, I would probably take profits. But you have to consider the possibility that October 13th, the day of that CPI print of 8.2%, you have to consider the possibility that that was the low and we actually are in a bull market. And one of the points that I've been trying to make is that CPI is going to be coming down hard in the next 6 months just because of the way that it's calculated. If we're still getting tiny amounts of inflation, if we're getting 0.2% inflation per month, CPI is going to be at 4% in 6 months. And the psychological impact of that is going to be huge. So just, November 10th, when we get CPI, if it comes in 7.9, 7.8, 7.7%, like that's going to be a big psychological boost to the market.
One thing that I haven't heard many people talk about yet is simultaneous with the Fed, if they are in fact pivoting, like you said, it's happening simultaneously with China indicating that they might finally be walking back from the zero tolerance policy for COVID. They might be opening up again. So you're going to have the situation where the Fed is easing a little bit on their rate hikes, and at the same time, China opening up could, in theory, create this surge of global demand again at kind of the worst possible time. What does that factor into your view on inflation rates globally and on future Fed policy?
I mean, yes and no. I mean, I don't think that doesn't really have much of, that's a very slow moving catalyst for inflation. I mean, I think that would feed into the data like a year from now. I think in the near term, there are some other possible catalysts. We have the election coming up, and a lot of the recent polls indicate that it looks like it's going to be a Republican sweep in the Senate and the House. That's a positive catalyst. We're also in a time of year where we have very positive seasonality going into year end. The market usually rallies in November and December. Bear markets usually end in October. I think that's what happened this time. So there's a lot of reasons to be bullish.
You know, this press conference, it was really interesting to watch. Answering one question, this really struck me. A reporter from, I believe it was Market Watch, asked Powell a question. And he responded at one point. He said, look, you know, one of the things that's frustrating for us is inflation. We haven't seen it come down. But actually, well, we have seen it come down, but we've seen core go up. Like, that was almost verbatim his answer. It's so, and while he's saying that, the market was just whipsawing all over the place. The message this feels like a big fumble, I guess is what I'm trying to say.
Yeah, it is a fumble. I mean, first of all, like, I've heard sort of secondhand through people at the Fed that the Fed doesn't look at CPI. Like, the Fed has lots of data and they have their own metrics that they look at for inflation. I mean, if you look at a lot of these real-time measures of inflation from private sources, you can see that prices are coming down fast, whether it's used cars or airline tickets, or like, there's, you know, prices are coming down pretty fast. CPI lags a lot. It's kind of surprising to me that Powell is getting into a discussion about CPI in the middle of the conference. CPI doesn't tell you what happened today. It tells you what happened 6 months ago. So if the Fed really is looking at CPI, like, they're way behind. So, I mean, just look at something like ISM prices paid. You know, ISM prices paid is back to where it was in 2020 before the pandemic. You know, its prices have come down a lot. There's a lot of measures of inflation that tell you that it's already come down a lot, except for CPI.
But Jared, the Fed's been pretty clear that they want asset prices to come down. And I'm not just talking about the price of chicken in the grocery store or gas at the pump. I mean, they want housing prices to come down. And they overtly are saying that they want stock prices to come down. Neil Kashkari saying overtly he's unhappy when the stock market rallies. What does the Fed do if the market continues to rally, like you are saying it will?
Yeah, I mean, that's the part where you really get into fighting the Fed, right? Because, you know, like you said, Kashkari says he's upset when stocks go up. I mean, he's kind of a ding dong, but, you know, like, if the Fed really, you know, believes that, like, that stocks going up are bad, then it sure is hard work being long stocks. You know what I mean? But in terms of, if you want to talk about asset prices going down, they already have gone down a lot. Now the stock market is down about 20%, but the bond market is also down about 20%. And if you look at the value of bonds globally, $15 trillion have been lost in global bond markets. And what that means is that between bonds, between stocks, between all assets, there has been more wealth destroyed in this bear market than in the financial crisis. There's actually been more money lost today than in the financial crisis. So, you know, for the Fed to pick a fight with the stock market and say stocks need to go lower, like, it's really, that's only a small part of the picture. So we've, you know, for the people who say, like, we haven't taken enough pain, we've taken an insane amount of pain already.
You know, I think you make a great point, too, about the midterm elections. There's certainly going to be more support for a higher stock market and bond market if there is a change in administration.
Yeah, for sure. So that's gonna be interesting. That's coming up soon.
So let's talk about some asset classes. What do you think about bonds right now? And bonds being a big word, but fixed income, where are you looking for opportunity?
I mean, a lot of active bond managers really got burned this year. They're underperforming the benchmark. They're underperforming the ag, because typically an easy way to perform the ag is to get overweight corporates and overweight mortgages, and you pick up a little spread on yield. And that didn't work this year because credit's gotten killed and mortgages have gotten killed. So 60% of active bond managers have been underperforming the ag. But now is the time to pick that stuff up. Like, you can get great IG bonds, 5.5, 6% yield. High yield is 9, 10%. Like this is, I mean, these are yields we haven't seen in a long time. And it's weird because, if you go back to 2021, when you had all these negative yielding bonds and people were complaining that you couldn't get any yield anywhere, well, now you can, and nobody's taking advantage of it because they're too scared. So those opportunities are there.
This is one of the big curses of investment research, the business that you and I are in, is when people should be buying is when they're the most terrified. But when the market is ripping and firing on all cylinders, everybody wants the latest stock tip, and they get upset when you toss a word of caution out there, especially if you miss another 5 or 10% rally upwards. Never mind the fact that you are keeping people out of harm's way. It's there are days when it's hard to hard to feel good about being in the office because you're fighting human nature.
Yeah, definitely.
So can you tell me a little bit more about sentiment and how you apply sentiment to investing? Because it's really kind of the biggest driver, in my opinion, of what you do and what helps you time your buys and your sells.
Yeah, so sentiment always works. Always works. Sometimes I get people that tell me like, it's not working. No, it's going to work. It absolutely works. If you're a technical analyst and you look at charts, that doesn't always work. If you're a fundamental analyst and you're trying to find cheap stocks, sometimes the cheap stocks get cheaper. But, universally, if sentiment is really bad on a stock or an index, like that is the time to buy. And if sentiment is really good, that is the time to sell. And the thing with sentiment is that it's very difficult to quantify. And what we do in finance is we try to quantify everything. And there have been some people that have tried to quantify sentiment. I mean, it takes some very sophisticated, computing techniques. But it's best done just anecdotally. Stories, anecdotes, things you read on the internet, talking to people, watching TV shows, clues you pick up. You talk to real estate appraisers, you talk to elementary school teachers, ask them how they feel about the market. I am always collecting information. Whenever I talk to somebody, or if I'm watching TV, or if I'm on Twitter, I'm always collecting information. And I try to determine when sentiment gets extreme. Now, the thing about sentiment investing is that it's really helpful on the extremes, on the bullish or bearish extreme. But at the 50-yard line, it's not that useful, okay? So when you have these periods of time where sentiment is kind of, adrift, like going nowhere, it's very difficult for me to operate, but I'm really good at the extremes. So, people have called me on Twitter this year. They've called me a permabull, because I'm always out there, because I'm bullish. And I'm like, you guys obviously weren't following me in 2021 because I was just the opposite. So I don't play for a side. And a lot of people in the research business, I call them one-sided analysts. You have people that are just bullish oil all the time. They're always bullish oil, or they're always bearish tech, right? Like that's actually a great way to get followers because you're very consistent in your message and people stick with you over time. But what I do is actually not a good way to get followers because I change my opinion quite frequently depending on where sentiment is.
You prefer to make money over starting a cult.
Yeah.
Well, and when you're at that, like you described it, the 50-yard line, that's kind of when you're really not supposed to be doing anything anyway, right?
Well, that's when you're supposed to be trend following. So, what sentiment investing is, it's mean reversion trading. So you're picking extremes, you're buying the lows, selling the highs, but and you can make a living doing that way. And some people do pretty well, but the real way to make money is by hopping on a trend and adding to a position and making just, multiple triple digit returns, so that's the thing I kind of struggle with. I'm not the best at that.
Okay, but to be clear, you believe that that at least for a while now, stocks are going to be in a bullish phase. I know you cover this in much more detail and give actionable advice in the Daily Dirt Nap. So I don't want to ask you to give too much specifics away because people pay you for that. And we'll have a link to the Daily Dirt Nap where anyone who wants to check it out can do so, and they should. I read it every day. But are there any specific sectors that you feel are poised to outperform given your call?
Well, there's one in particular. I think industrials. Let me back up a little bit. If this is the beginning of a bull market, which it could be, it really resembles when the bull market started in 2003. Okay, so after the dot-com bust, 2000 to 2002, and stocks started to rally in 2003. The interesting thing about that rally is all the dot-com stocks were dead, they didn't go anywhere. But it was industrials, it was basic materials, it was stocks like U.S. Steel and Cleveland Cliffs and Phelps Dodge, because the dollar was weakening, and industrials like GE at the time. So what you've seen in the last month is that the Dow has massively outperformed the NASDAQ and the S&P, and that's because the Dow is by nature industrials. Pull up a chart of XLI, industrials. So actually what I think we're at is I think we really are at the beginning of a bull market, and we're getting new leadership. And by extension, a lot of these stocks are value stocks, and value has been working for the first time in a long time. We talked about that before this call. So that's what I'm most excited about.
Jared, I know you cover this every morning in the Daily Dirt Nap. Before we had the kickoff for this interview, you mentioned that you'd be willing to do a special offer for anyone who's viewing. So in the YouTube description and in the email that we send every week, we'll have a link where viewers, if you're not reading the Daily Dirt Nap, you can get a special offer to check it out. Like I said, it comes out every morning that the market is open. I read it every day. It's made me a better investor. I think I'm in my 7th year as a reader. Jared, it's always fun talking to you. Thanks a lot for your time, my friend.
Thank you.
Thanks for watching this week's Global Macro Update. I'm Ed D'Agostino from Malden Economics. Take a minute to subscribe to our YouTube channel. Thanks for watching. I'll see you next week.